Hello ladies and gentlemen, and welcome back. Well, I can't think of a time in more recent history where the bulls and bears, traders and investors have disagreed more. The bulls want the moon and the bears want markets to return to 2020 highs. Basically, this is a market where no one can agree on anything, but it's also a market where we've been at the same price only a few months ago. So what's changed? Well, part of it's the trend line and the fact that everybody's been talking about this being broken. And I think the second part is technology stocks. Yes, the favorites of retail traders out there like you and me are starting to run again. And with every single dip in futures market action being bought by huge rips, it kind of reminds you of conditioning. So is Wall Street setting the trap still for retail traders out there, or do we have to admit that these next gap fills are on the way? Let's discuss some of that together right now. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos. We'll be going through the big news, the macro data, the lead indicators, and of course everything you need to see on the charts right now in today's show. But let's begin with the S&P 500 GDP report. It came in pretty hot, and a lot of you out there were messaging me saying, well, doesn't this mean the Federal Reserve has to go harder and faster? Well, theoretically, yes, it may mean they have to do that. Remember, the Federal Reserve is trying to cool the economy partially here without maybe causing too much of a recession. The soft landing story comes to mind. But yes, the bonds market actually did see a spike in yields across the board. And remember, we're in a disagreement between the markets and the Fed. The Fed say 5% plus, the markets say you can't do it. They're saying 4.8 at this stage. So this could be also a catalyst that comes to play in February and March as we see more things coming out for the Fed. Let's talk about earnings though, because we are in earnings season and we've got the earnings hits and misses so far. And the report is actually looking relatively positive for now, but we still haven't seen some of the other big tech stocks at this stage. What's apparent though is that companies are starting to sack people. Hasbro plans to lay off 15% of their workforce. They're just basically adding to a whole bunch of sackings that we've seen through. Bed Bath & Beyond, of course, looks absolutely horrific. Plunges more than 20% after filing, shows default on loans, so certainly looking pretty poor there. And we're seeing demand destruction come through for Intel as well. Intel seeing more losses as PC makers sharply cut chip buying, and this is, of course, seeing a slump in after-hours trade. So what do we then do? Well, let's take a look at the facts that we know right now. Remember to follow us, links in the description down below, at FX Evolution on Twitter. We post a whole bunch of charts that we share here on the daily videos, but also some extra stuff, so follow along there. Let's have a look at the Fear and Greed Index. Now, I've been following this recently. It's been slowly ticking up as we move up, sure, on stocks, but realistically, the S&P 500's only been doing, basically up and down for the last couple of sessions, yet this is still rising quite aggressively. So we're at a 69 here in terms of greed. We're almost entering that extreme greed zone, and that's where you've got to be careful. Do we see a trend change at this stage? No, we don't on markets. And we certainly haven't seen necessarily the flow into defensive sectors that we would expect so far. But this is something that you have to keep in mind. If you see a switch of trend that pushes the bear narrative and at the same time you've just come off extreme greed, well, you might want to be paying attention with those options and those futures trades. Let's talk about, though, what happened over the last 24 hours. Energy was the best performing stock index. Then we had consumer discretionary and all of the usual 2023 kind of sectors. Mostly growth and hyper growth were doing pretty well. And if we move over to the 5-day average, you can really see how well specifically stocks like Nvidia and semiconductors have been doing. 9.4% up over the last couple of sessions. Look at the bottom, staples, healthcare, utilities. So 5 days, absolutely no real rotation into those, which, for bears is going to be very difficult because, of course, we usually see that rotation. What about the beats and misses? Well, for this early in the season, it is actually pretty bad. 62% beat rate is pretty poor. Beats 222, misses 135. Generally, this early in the earnings season, you're going to be looking at a 75% plus beat rate. So it's actually pretty weak, and this is something that we'll have to be covering. And of course, as we get deeper into earnings season, this is going to matter to the market. It's not just the current beats though, it's mostly the forecasts in the future that the market is looking for at this stage. Let's talk about earnings. We've got a couple of big ones coming out. Obviously, we've got Chevron, American Express on Friday. Make sure that you're looking at those, and those ones will be important. Two massive companies. And as we mentioned, Intel just came in pretty weak on the markets. Let's move over to the charts. We've got the VIX to start off with here. VIX sitting back down at 18.72. Pretty much during 2022, and most times, if the VIX is coming from well above 20 and then it's starting to dip back under anywhere between that kind of 17 to 20 zone, this is where bulls have had to be careful recently. Every single time it's reached into these areas, we've been hitting critical resistance, or we've been around a zone where people have really been disagreeing with each other. Remember, it's been basically buying markets at 35 and reducing positions at that 17 to 20 zone. That's worked quite well over the last kind of months and years. Let's move over to US 2-year yield though. So this is inversion. So I just want to show you where the inversion's at. We haven't done that one in a while. The US 2-year versus 10-year. Now we'll go to the US 2-year, which is sitting at 4.187. Now this was actually up on the session. So that's the weekly. You can see here the daily. Again, markets are ripping. Yield's not exactly dropping off. And that's something to definitely be looking at here. In terms of forward yields, the market's still not agreeing with the Fed, 4.8%. The GDP did nothing to that. And I think we'll have to wait and see what the Fed actually is going to say in their upcoming meetings, because that's going to be very important. Make sure to watch our weekend video and subscribe to this channel, because we'll be covering a very in-depth look at the markets as we see this weekly close. It is so important what happens this week. And yes, we've got one more trade day left to find out what will occur. Imagine if it rejects, even though we've closed above 40.40, and we end up seeing this huge rejection through the Friday. Well, that could change everything about the bulls and the bears moving forward into the next couple of weeks. Put call ratio is actually starting to look okay for some of the bears. If you're a contrarian, this is something that you can use. Usually you want to see kind of the level of puts reducing drastically, and you want to see a huge amount of increased calls. And when we take a look at Tesla, you'll see some calls coming through. What about the dollar? Well, the US dollar did have a nice kind of resurgence for part of the session, but I'm looking at the weekly close here. I think it's incredibly difficult to make any decisions about the US dollar at the moment. We're at a huge level of demand, a huge zone, and we've seen one strong rejection. Obviously, it ended up being a long leg doji, and at the moment, we have another long leg doji. A high, a low, an open, and a close at the same point, all sitting on those monthly, daily, and weekly close levels. So nothing we can really ascertain just yet, but we do know critical zone for the DX, and if it moves through either way, we're going to probably see a very large move and probably pretty aggressive. What about gold? Well, it's starting to slow. It's a dulling market. So basically that means that each time it's going to new highs, it's doing so with a little bit less steam. Now that doesn't mean it's an instantaneous, oh, let's short gold, because shorting dull markets is not necessarily the best technique. But what we can see here is it's been great to trade within. We've been talking a lot about these levels of demand in recent weeks. We obviously spoke about this level here, and each time it's been ripping up. The trend is still currently up, so therefore there's a lot of that latent slack demand where it comes back into demand zones, and we're seeing that strong buying. What is interesting is we made a slight low under this level, but we haven't broken under here yet. So we're probably looking at seeing the market go under 1916 to 1912 before you can really start to say, well, this is actually looking a little bit more bearish. At this stage, the bulls still technically have control of gold. US oil continues to hover around. Nothing super interesting here. We're not back down to the 78.20s where we expect bulls to probably try to show commitment. And we found that, of course, the buyers have been recommitting to oil. Oil is poised to maybe have a nice breakout moving forward on it. And you can see here the 82-83 zone. This is where realistically we've seen huge amounts of selling in the past. But at the moment, the market's, hovering around, looking like it's building a position and potentially breaking out to that $88 to even $92 per barrel. Very interesting weekly close. Keep it on the charts. Now, everyone's sending me messages about natural gas, and it's not new. I've actually had messages about natural gas now for weeks. But the problem was people were trying to buy here. And what I like to do is if everyone's sending me something and it looks horrible on a chart, because it has looked horrible on a chart, you probably don't really want to be buying it. It basically means that we haven't necessarily seen the lows. I wanted to bring natural gas up because it's called the widow maker for a reason. Everybody was big on buying gas and buying this into, of course, the Northern Hemisphere's winter, and it just was a terrible trade. This was an absolute classic case of where people buy the rumor and then sell the fact. Now that we find ourselves where we are right now, though, I do think we'll have a bit of a special this weekend where we might go through a couple of natural gas stocks, because there's some interesting things happening on natural gas stocks. And where we look at natural gas on a chart right now, we're at that extreme low. Basically, people will be losing faith on this type of trade at the moment. It's not time to just go jump willy-nilly. It's called the widow maker for a reason, but it's back to 2.8. That's incredibly low. And of course, moving back into that really big structure zone. So I'll be the first to put my hands up and say that Tesla's gone a little bit higher than I thought it would. Of course, I thought it would sit between 150 and 155 by the close of Friday. Hey, I've still got a day left. But yes, this is the level where we're seeing still a huge amount of options interest, and people are super hyped after that huge rally that we saw pretty much through the call, well, the Q&A session, I guess, with stocks. You can't expect any company, especially Tesla, to say anything negative, but the markets took it and absolutely retail ran it up. So here we have 164.63 is the new expected move, potential high, and we have the 156. Now, this is for the Friday options expiration. Obviously, it's not my opinion, it's the opinion of the options market in terms of the expected range. And if we go over to the options market, what you might notice is that 160 calls absolutely got bought heavily on the last session. So 160 calls, 150 calls. If the market does end up going bearish on Friday, be very careful around these periods. This is not usually a zone where I would hype in. I mean, anything past 150, I probably wouldn't have hyped in. That's the way I really think about markets. I like to just go to the zones that make the most amount of sense. We knew 150, 155, or even this 160 range is going to be tight. We know, of course, where theoretically the max pain is, not that we're paying that much attention to it. So if markets are going to hold themselves, usually this is where it is. And just go back to that chart for a second. That is a huge gap. In fact, I've actually priced that gap now, just in case. If we go to the weekly, you can see where we're at. And you can also see that we're starting to appear back to where all of this really began at 165. So tough times for Tesla traders, mostly because we're now at those super critical zones. Anywhere past 150, we're entering into, I would say, probably a little bit of FOMO. Just even the way it's rallying with the gaps and leaving all those gaps behind, you've got to be careful. Let's move over to Apple. Now, on the surface, this daily has closed above. Well, it absolutely has. We still don't have the weeklies closing through, so I'll probably look towards this on the weekend. But look, it was a strong session across the board. Whether you're looking at Apple, it's theoretically a breakout. If we're looking at Nvidia, it actually broke all these previous highs. Notice I've got this little left-hand side just in case, because this is the type of one that I would like to usually come in on and look for traps. So that's really, because I know retail traders love Nvidia. Of course, we all do. It's a great stock. It's a great AI play, etc. I love it very much. But this is the type of area where you're looking for those potential high reward false breaks to the upside. If you take liquidity in these zones and you instantly reject it, you usually, as a bear or a bull on the bottom end when you're looking to buy, these are the types of areas where you look for these kind of swing failure points. It's very important to always keep an open mind both ways. And at the moment, I mean, you would look at this, and I think everyone will be talking about, they'll all be saying, oh, look at this inverse head and shoulders. Look, anyone can see that inverse head and shoulders. It's not hard. We know it's critical. We know it's through what we've been using to short the market recently. What we don't know is whether it's through that real supply that was over here. So with Nvidia, I'm going to hold judgment on the weekly close. I think it's the only way we can look at this. This was the indicator that really started the rally to me in terms of consumer discretionary, technology, all those things. I thought I'd bring it back just to show where we're at right now. Never lose sight of the fact that it's really important to think about consumer discretionary versus staples. It's a big deal. And look at this, just this huge rally coming through. We haven't even seen it slow down yet. So there's not one real session here where we've seen consumer discretionary lose to staples. And I think that's pretty important. So we'll keep back to this on the weekend. And realistically, that was a big gap up. So again, does that show us that there's a little bit too much FOMO coming in? To put it in perspective, don't you worry, staples is still well ahead for a while now, but we're back in these critical areas for it. So we'll come back and do some analysis on that. Russell 2000 still didn't really break through. We have that 1900 and that little high over here as a read. We're through it. Theoretically, I'd like to see the weekly close still, just because to me weekly closes mean a lot. And we have on the futures action, of course, strong looking charts, basically dips being met by rips, dips being met by big wicks. You can't deny it. I mean, the trend is still currently up. For a bear to win out on this one, you either need to go really small time frames and you're looking at things like the S&P 500, Nvidia and those types of things, and you're looking for little switches, or realistically, you need big drops taking out those actual demands. We haven't taken any demands on this rip up so far. So every single time we've just come back down to the level and seen buyers recommence. We need those levels to be taken if you're a bear in these markets. It's the same thing with the Nasdaq. What a critical pivotal zone. You'll notice here that we have what we call an Eve and potentially Adam double bottom kind of thing going on here in the markets. If we breach through this zone, well, does that begin an incredible rally? I always like to say, does the market proof a concept or proof, something on the charts? And the way you can do that is you'll get your range, you'll pull it, and then you'll basically just say, well, does that make sense? Well, look at this. I mean, these things are proofing towards these highs. So, so much at stake this week and maybe even into next week and the Fed and those types of things, because look at that. I mean, it's, it doesn't lie. It's exactly what it's proofing. The same thing happened with Nvidia with the inverse head and shoulders. It's either a glorious trap or we're going to move to another point. Look at this. Same thing with the Qs. We break through. We get through these highs with weeklies. It's going to be a big deal. We'll check all of this out. You've got to watch the weekend video. It's going to be super important. Let's move over to the SPX. We know that when we broke through 40.40, it was a fairly significant number. We can think about these 41.13s. Again, this is going to be that next level for the big bears. If they're trying to predict where the zones are, then the next one is that 42.83. There's gap fills all over the buy side. If the market's going to go bearish, though, you'd probably want it to go bearish on Friday, and that's just because it goes too much more bullish. We're starting to push some of those Q zones, some of those Russell zones, and even really closing above for things like Apple and other stocks. So SPX at the moment, a lot of green days. Historically, 1, 2, 3, 4, 5 green days is a lot in a row without a red day. But we're in that area where you've got to be careful. I said about 40.40, probably 41.13. I guess I'll stick with that for now, but of course we'll see that weekly close and play whatever's necessary. Here's the expected highs and lows by the options market for the Friday in terms of where targets could be. Obviously they're saying 68% of the time the market will stay within this range. That's something to be noted for. If you ever see expected highs or lows appearing on support or demand, that's going to be critical zones for you to watch. Now let's move over to the US 500 futures. So we know where some of these daily closes are. We also know that we've got these big wick rejections. So I'm going to have an alert that I think is worthwhile setting at 39.50 in the future. So make sure that one's probably on your chart. It's going to be a key. And if we take a look at it, what you'll notice is that the market was really actually quite interesting. It actually interacted with 40.40, 40.50 pretty bearishly for the start of the session. So we saw that rally where the market went up to the zone, it instantly rejected it, and then we saw a nice sell-off for a little bit, and then of course that huge rally at the end. It's interesting to see the sell-off. Obviously, that's designed to trap people into shorts, but actually as an intraday trade, the sell-off, if you were looking for it just into here, would have been okay, and that's probably the best trade of the session in terms of recap. And then you get that really strong buying. So every single time it's coming to any minute demand, we're just seeing huge buys. I'm very interesting on the Friday. I think actually it's almost one of those days you'd almost consider sitting out of it because of how much is going on in the markets right now and how much matters to this weekly and in fact the January close. So many great profit targets have been had. Congratulations to anyone that's been running these rallies. But this was a very simple day. Like, when we saw the markets come back down to this area, that's way more simple than what we're dealing with here. This is where you start to get into that really questionable area. You see cleans of 41.13, you see big closes there. You certainly will be paying a lot of attention. SPX did close on its high. That's worth noting. Whenever markets close on highs or lows, that usually means there's a little bit more to come. Historically, that's what tends to happen, but we haven't had one red day. We certainly cannot be calling anything to do with bears just yet. There's just nothing to say so at this stage on the charts, and we've got to be objective about it. When we're talking about Friday expiration, yes, technically Max Pain is lower than the current market price by quite a lot. It doesn't matter as much though because there's so many less units, only 1.3 million in comparison to others, and people have been stacking 390 puts at this stage. But look at the 410s. 410s starting to rise, calls starting to come out. We saw it with Tesla, we saw it with a lot of individual stocks. People are buying back into the FOMO and starting to make some outrageous calls. So I'm very interested to see the Friday session so that we can then have a look at the upcoming options and make some bigger decisions, I think, based on those. In terms of news moving forward, we have not too much coming out. Obviously, core PCE price index, 8:30 a.m. Friday morning, New York time. And if we move over to Bitcoin, which is the final one here, almost no change from our thought process in the other video. We rallied, we definitely made a higher high. That 24 to 25,000 is a critical supply zone. But if the markets now break underneath 22,275, because look at these, they're all wicks, we can probably guess that the markets are wishing to go back down and test into that 21K. So I actually don't mind that if you're looking for the negative side. For now though, Bitcoin hodlers, there's nothing to be concerned about. You haven't seen an actual shift. It just hasn't happened. So you've got to basically always be holding when you feel like markets are going, bullish. And when things change, when the actual patterns change, that's when you've got to start to say, well, I need to maybe trim my position and everything. Thanks so much for watching. If you enjoyed today's video, then make sure to subscribe, smash that like button, and remember to follow us on other socials down below. There's a Linktree link, which you can follow our Twitter, our Discord, and everything else we offer you guys. That all stuff is free, so definitely check it out. Bye for now.